In previous videos, I've talked about the importance of risk control to try and help the average investor have the best chance to meet their objectives. Poor risk control does tend to lead to bad outcomes. And some of that is psychological, but some of it is actually practical at different stages of life. It genuinely leads to lower returns. But investing isn't just about controlling risk, it's also about generating returns. And there are ways you can use risk control, in my opinion, to lead to better returns as well as reducing risk. And today's video, I'm going to discuss that and try and give you some examples of how you might think about it yourself. So if we're going to try and use risk control to improve returns, the best way of thinking about it, in my view, is to try and look at assets relative to what you would consider their fair value to be. Clearly, if you buy things above fair value, you're likely to make poor returns and vice versa. So if we think about assets fluctuating relative to fair value, there are two big kind of cycles that happen. There's the long-term cycle, and then there's a short-term cycle where the fluctuations are more rapid. If we're looking in the long term, we should take every asset and we should understand how that asset trades based on the common valuation metrics that are used relative to its own history. So if we look at the stock market, the best measure to use is cyclically adjusted PE, which takes last 10 years of profit, which means that we smooth out the effects of boom periods and recessions and interest rate changes. We average the last 10 years of profit from that stock market and we compare that to today's price. And if we use that measure, it gives us a very stable and good predictive measure to try and understand what future returns are going to be. So if you buy a stock market at a high cyclically adjusted PE compared to its history, your future returns are likely to be quite poor, and vice versa. So in our experience, this is an excellent way of trying to construct a portfolio so you avoid the areas of the market which have the highest risk, so you can reduce the risk and actually, hopefully over time, improve the return. The second way of looking at it is in the shorter term, which is the more short-term fluctuations in asset prices. Now again, with any asset, you look at it and you can see, if you look back in history, you very often see quite wide variations in the price of that asset, and it'll be moving up and down, not just in one direction. So in a portfolio, if you imagine you have a lot of assets, a well-diversified portfolio, and you'll have some assets that perform very well in the short term and some that perform badly, rebalancing is the automatic process that you can use within a portfolio to sell down assets that have increased as a percentage, performed well, and buy into assets that have reduced to try and bring the percentages back to some kind of target figure. Rebalancing is actually an excellent way of using the fluctuations in assets to sell high and buy low and add a bit of extra return to your portfolio while reducing risk. But in of itself, of course, rebalancing is not going to generate great returns. It's just going to help you in the margins to do things a little bit more effectively than you otherwise would. If you've enjoyed today's content, I'd really appreciate it if you clicked the like button. If there's anything that I've discussed today that you'd like to know more about, please get in contact with me. But before I go, I must remind you, I have been talking about investments, and you must remember that your capital is at risk. Thank you.